I'm going to show you a mortgage strategy to save hundreds of dollars every month when buying a house in today's market. Even though interest rates are up, that doesn't mean that you have to have a really expensive house payment. Before I get started, please subscribe to the channel, like this video, and if you have questions going through it, drop a comment. Now let's get into the numbers. So this strategy is a great benefit to a potential home buyer, but it gets even better because in today's market, you might even be able to ask the seller to pay for this benefit for you. Remember, when you're buying a house and you're writing an offer on a contract, everything is up for negotiation. So in today's market, sellers are more likely to offer you a credit or a discount on the home itself. So I want you to keep that in mind while we talk about this strategy. So every time I meet with a client, I always offer 3 different financing options. A lot of companies will just give you an out-of-the-box loan pre-approval, and you don't really realize everything that's available to you, which includes this strategy, which is the 2-1 temporary interest rate buydown. Now, I already explained the concept of the permanent rate buydown, where you spend a lump sum of money up front, whether it be your money or a credit from the seller. But keep in mind, if you refinance 6 months, 12 months, 18 months down the road when rates go down, you could lose out on the benefit of spending that lump sum up front. So the 2-1 temporary buydown is super cool. It's similar to the permanent rate buydown in that you pay a lump sum of money up front, but this money is actually held in an escrow account on your behalf. The lender collects a fee up front and they give you a 2% reduction on your interest rate for the first year, a 1% reduction on the interest rate in year 2, and then for the remaining 28 years of that loan, you get the market rate that you would have had you not bought the rate down at all. So again, if the interest rate is 7% on the 2-1 temporary buydown, your interest rate and payments for the first year would be based off a 5% interest rate. In year 2, it would be based on a 6% interest rate. So the money that's collected to do this buydown, remember I said it was held in an escrow account. So what happens is that escrow account prepays the interest for you each month, giving you a lower monthly obligation. But check this out. If interest rates drop in the next 6 months, 12 months, 18 months, whatever money is left in that account upon refinance will actually go to pay down the principal on your mortgage. Regardless of whether you keep the loan or if you refinance it on the short term, you never lose the benefit of that money. Sounds great, doesn't it? Well, I wanted to show you in real numbers how much this can potentially save you on your monthly mortgage. So now I'm going to show you a real example of what these numbers would look like today. Okay, so here's the presentation showing a $500,000 purchase versus a $500,000 purchase with a permanent interest rate buydown. And then the last column is the 2-1 temporary buydown. So as you can see here, the payment savings for the permanent interest rate buydown is only a monthly savings of $149. Using the 2-1 temporary buydown, your first year savings on that same house would be almost $600 a month. Now, let's look at the closing costs to show the cost of each rate buydown. So here you can see that the cost of points to buy that interest rate down and save $150 a month is almost $15,000. And the cost of the permanent rate buydown is a total of about $16,000. So for a very similar cost, you can save almost $600 a month for this house. We can also look at our payment breakdown and see what the payments look like over time. So on the permanent interest rate buydown, yes, you get that 6.5% interest rate for the life of the loan. So keep in mind, interest rates do go up and down over time. So we should see rates come down hopefully in the next 12 months. So if we look at the payment stream on the 2-1 buydown, Your payment is based off that 5% for the first year, saving you only almost $600 a month. So your first year payment is about $600 lower than the market rate. And then year two, you still save almost $300 a month. So again, if we believe you have an opportunity to refinance in the next 2 years, the 2-1 buy down is definitely the way to go because you're never going to lose the benefit of paying those points and closing costs up front. And that is how you can save hundreds of dollars on your mortgage payment in this market using a 2-1 temporary interest rate buy down. If you want to see one of those presentations custom made for your situation, drop a comment below. I would love to send that out to you. Also, check out my other videos. I have a number of mortgage topics on my channel, so take a look at that. And if this was helpful, again, please subscribe to the channel.